Hello, everybody, and welcome. I am Betsy Kenyon. I am our Director of Marketing at Elevate Wealth Advisory. For anyone who's new to us, we are a wealth advising firm based in Athens, Georgia. And today we're really pleased to welcome our partners at First Element Insurance Planners. Like Elevate, First Element believes in a client-first planning-focused approach. They work alongside fee-only advisory firms such as ourselves to provide objective guidance on insurance and risk management planning without compromising that fee-only model. So we really value our partnership with First Element. Their expertise helps us deliver more comprehensive advice to our clients, especially in important areas such as long-term care planning. Insurance is always one of those things that no one really likes to talk about, but is definitely something that is needed. So we're really happy to have you guys back. It's been about 5 years since we've had you on with us, but your webinar that we did 5 years ago remains one of our most watched and most popular webinars throughout the years. So today I'm going to introduce Dan Sullivan with First Element Insurance Planners. Dan has been a great resource for our team and our clients, helping ensure that risk management and insurance planning are integrated into our comprehensive financial plans. I'm going to turn it over to Dan, who will introduce today's featured presenter, Michael Tesler. Thanks, Dan, and thanks, Michael, for being here with us.
Thank you.
Thank you, Betsy. It is a pleasure to work with your team to help clients with insurance planning needs, and we really appreciate the opportunity to speak with you and your clients today. I'd like to introduce the speaker, Michael Tesler, who is the president of First Element's parent company, BUI. Michael has decades of experience in the life and long-term care insurance industry, and he works closely with financial advisors to help individuals, families, and business owners navigate estate planning and long-term care planning strategies. So Michael is truly an expert in the areas of life and long-term care insurance, and he has been an invaluable resource for our clients. So with that, Michael, I am excited to pass it over to you.
Thank you, Dan, and thank you for the very, very nice comments that you made. I appreciate that. I heard earlier that nobody likes to talk about insurance. Well, I do. So if any of you want to talk insurance, call me anytime. Before I jump into this presentation, there's a couple things that I want you all to know. You'll notice that there is no particular insurance company or insurance company's individual products or anything like that mentioned in here. This is not about buying a product. This is about providing you education on long-term care insurance, and so you will not hear anything like that. Secondly, in the spirit of full disclosure, you should know, I visited my great-grandparents in a nursing home. My grandparents, 3 out of 4 of them, required significant long-term care or care in their later years. My father-in-law, who is no longer with us, his last 10 years of his life were spent with 24-hour-a-day round-the-clock care, and I currently have 2 parents who are both require 24-hour-a-day care. So I think that's important. Maybe I'm a little bit biased based on my family circumstances, but want you to know that about that as we move into this. The last thing that I want to share with you before I jump into the actual presentation, you know, they say you're never supposed to give away your most important point right up front. You're kind of supposed to save it for the end. I'll mention it again at the end, but I'm also going to mention it right now. If there's anything that you take away from this meeting, and I hope you take a lot away from the meeting, but if there's any one thing that you take away, it's you got to have a plan. And that plan doesn't start when your circumstances change. It needs to start long before. Who's going to do what? Where will the funds come from? How does this play out in my personal financial and family world? You know, and if you don't think about it well in advance, you're going to find yourself making difficult decisions at a difficult time, and perhaps more importantly, somebody close and important to you is going to be making those decisions, and that's never easy. So, with all of that said, let's jump in. So in the old days, whenever we did meetings like this, we would always give you all the statistical data, basically to try to scare the bejeepers out of you into thinking, you know, to buy long-term care. We're not going there today, but here's what I'm going to leave you with. When it comes to needing care as an elderly person, to be honest with you, it's not really an if, it's more of a when. I speak to groups of financial advisors, accountants, attorneys, and folks just like you all the time. And whether I'm speaking to a group of 10 people or 1,000 people, if I say to the group, everybody raise your hand if you've had a situation in your family that where you've had a family member that required care, 100% of the hands go up. And yeah, thank you. 100% of the hands go up every single time. So it's not a matter of me presenting you with a bunch of statistical data. It's a matter of recognizing this is a pretty real thing. So when we talk about this, it's really important for people to kind of get their arms around what is important to them. And for many of you, you've spent your lifetime taking care of people that you care about. And it's in some ways it has actually kind of defined you. It is who you are. It is what you do, and it gives you purpose in your life. And and those people that you have cared for, spouse, children, etc., are not the people that you want to be, responsible for you. And yet, when you think about it, if you're going to protect those people and take care of those people, the steps you take before it should, heaven forbid, come a time when you are incapacitated in some way, is one of the best ways that you can protect the people that are most important to you. And let's face it, you know what you would do for the people that you care most about. You would do things even if it was to the detriment of your own health. And guess what? So will they. This is a very real situation. Providing care to somebody who is chronically ill generally makes caregivers chronically ill. And, there is a lot of statistical data beyond that, but most people who know situations like this can think of people who have had major health changes as a result of having to care for family members. In addition to that, it usually means that somebody's going to have to put their own life on hold to take care of you. And that's something that for a lot of people, it's not a comfortable thought. And it's one of those things that guides us to wanting to make a plan so that that doesn't necessarily have to happen to somebody that we care a great deal about. You would like to think that all children share equally in mom and dad's care. Let me assure you that is not the case. And I'm sure some of you have provided care to family members and may have siblings. And I can tell you, statistically speaking, the oldest female in the family is the one who will probably end up doing the most care. Frequently, that care has to do with geography. If one child lives in town where the parents are and the other children don't, that one child is usually shouldering a much more significant burden as it relates to family care. And the reality is, it doesn't usually lead to good things among siblings. And that can really have a long-term impact. I mean, you're talking about potentially generations, first cousins who don't get to know each other because their parents are still peeved at each other about how a family situation like caring for mom and dad may have happened. And those things don't generally get better over time. And I can tell you another thing about family situations, and that is if there's more than one marriage involved, there are usually more significant issues as it relates to all this. Are you using this person's money to pay for that person's care, which would have gone to this set of children, but not that set of children? And everybody ends up a bit unhappy in these situations. So really important, again, to have a plan so that everybody knows who's doing what, how's it getting paid for, etc. So when it comes to the payment for care, we've talked a little bit about the family issues, but now I'd like to jump into paying for care. And it's really something that you have to give special attention to, because generally speaking, it's going to require the reallocation of your resources. Because depending upon the type of care needed, et cetera, it can get very expensive very, very quickly. So you have to think about, where is my money going now and how will that change? Now, if you're like most successful people, you spend pretty much all that you make. Yes, you're saving and doing and what have you, but there's not an extra, many thousands of dollars a month that's been allocated, for this, because it's being spent on other things. So for many people, it is really about I want to set this up in a way to make sure that I can continue with the financial commitments that I've already made and be able to do the things that are important to me. And sometimes you have to think about this in ways that you don't want to think about it. If I suddenly had a major long-term care situation or care situation, how will that impact other things that I like to do? For example, a child that I'm helping who may have not made the best financial decisions or is still needing financial help from me. Or are there contributions to 529 programs for children or grandchildren or what the case may be? And will I be able to continue to do that if, in fact, I find myself in need of care? For many, it's about tithing and making charitable contributions. Sometimes it's personal hobbies, the boat, the country club, the whatever it is. And will those things still be feasible for everybody if there is a major care situation? And I remind you that, just because one person in a partnership needs care, that doesn't mean the other person does. So starts to become that question of, well, will I still be able to do those things that I've always done, even though there's a lot of money being spent on my spouse? It could be family vacations and things like that, club memberships. Who knows what things are most important? But again, having a plan that says, if this care situation comes up, what will I do? All right, so we've talked a little bit about how it affects the family, a little bit about how it affects the finances if there is a care situation. And at this point, I'd like to talk a little bit about you. So I've already said you got to have a plan. That plan does not necessarily incorporate insurance. It may or it may not. That's a decision that you have to make based on your assets and so on as to what makes the most sense for you. Okay? But I can tell you that for an awful lot of people out there, me included, my parents included, etc., long-term care insurance makes a lot of sense. And so I am going to talk a little bit about long-term care insurance and how it works. So it's easy to use the textbook definition that I put up here for you as the definition for what long-term care insurance is, but I'd like to give you a different definition to think about. Long-term care insurance covers the things that your other insurance doesn't cover. So if you are still working and you are on a medical insurance plan from your employer, and if God forbid you become injured or ill, it's gonna take care of you. If you need a hospital stay or surgery or whatever, it's gonna take care of you. And if you are already retired and you are on Medicare and or a Medicare supplement plan, again, same thing. If you get injured or ill, you need a hospital, you need surgery, whatever, it's going to cover that. But there's a different kind of care that many people need that is not going to be covered by medical insurance or Medicare. And that is the chronic illness type thing. I don't need a doctor. I'm not that sick. I don't need surgery. I don't need any of that, but I also can't care for myself. So I've mentioned more than once that I have parents in this situation. My father is in memory care. He has significant cognitive decline. He has dementia. Okay? He can't care for himself. He cannot fix his own food. He can't dress himself. There's lots of things he cannot do. And yet, he doesn't need a doctor or a nurse for anything. In fact, if you saw him, if I flashed a picture up of him right now, you'd say, well, he doesn't look too bad, that guy. And for 96 years old, he looks great. But the reality is, he does look good. He is physically okay, but he can't take care of himself, and he doesn't need a doctor. And as a result of that, the fact that he doesn't need any specific medical attention, his Medicare and Medicare supplement plans cover nothing. So all of the care that he gets, and he's in a memory care, so it's 24-hour-a-day care, all of that care is provided by either his own assets or an insurance policy. And in his case, fortunately, there is an insurance policy in place. So think of long-term care insurance as the insurance you buy that covers what your other insurance doesn't cover, because you don't have any insurance that's going to do what this insurance does. So let's talk about how it works. There are two ways that you qualify for benefits on a long-term care insurance plan. And you remember earlier I said I'm not talking about any specific company's plans. So when I talk about things like this, what I am talking about are the best plans in the market as a group. This is what they all basically do. And when you qualify for benefits, your physician is the one who is going to confirm your qualification, although many of the insurance companies not only get something from a physician, but they will do some sort of a personal interview with somebody to see how they are. They are doing both physical and cognitive testing, things like that, to see. But generally speaking, it's not, the point that I want to make here is your family member or you don't just call the insurance company and say, hey, I can't take care of myself anymore. Send checks. It doesn't work that way. So there are two ways that you are generally going to qualify for claim. The first one is a cognitive impairment. So for most of us, that's usually dementia or Alzheimer's. And cognitive impairments are by far the longest, most significant claims. So I've mentioned to you, of course, my father, who is in memory care. My mother is also in a similar situation, also needs 24-hour-a-day care, both of them in significant cognitive decline, and will be for the rest of their lives, however long that may be. You generally, when it comes to cognitive impairments, nobody recovers from them. Now, there is a possibility on a physical situation you would recover, but generally not on cognitive impairments. So if you are determined to have a cognitive impairment, you would qualify for benefits. You don't have to qualify both physically and cognitively. It's one or the other. Physically, however, we have what we call activities of daily living, ADLs. We love acronyms in our business. So if you read an article in Art Magazine or anyplace else, you'll see ADLs. Everybody loves to use the acronyms. Activities of daily living, which are the things that many of you on this call today already did today. They're the kinds of things you do every day and take for granted that you can do, and yet not everybody can. Bathing, continence, toileting, eating, dressing, and transferring. And by transferring, we are saying, can you get up and out of the chair that you are in, walk over, turn on the light, come back and sit down? If you're not able to do that, you're not able to transfer. And if you cannot do two of these 6 things, you would qualify for benefits under a long-term care insurance policy. So this is one of these these things that people get a little bit confused about in terms of how does one qualify. It's really pretty straightforward, and it is extremely similar with every carrier out there in the market. Now, when we start to talk about plans, there are 2 different types of plans, traditional and hybrid. And I will tell you that as of today, hybrid plans are basically the only ones that we would recommend, and I'm going to share with you why. Now, traditional plans have been around longer than any other plan. They are generally customizable. The initial premium tends to be low, but the premiums and the benefits are not guaranteed by the insurance company, which means that they have the opportunity to change the premiums and the benefits. And if any of you own a traditional plan, or if any of your family members own a traditional plan, you have already seen rate increases, because I am not aware of a single carrier in the industry that manufactures a traditional plan that did not increase the premium rates. From the best known, biggest companies that you've ever heard of to smaller, lesser known companies, every single company has increased the rates, or conversely, they give you the option to keep the same rate but lower your benefits. But either way, they're non-guaranteed, and just because they do it once doesn't mean they won't do it multiple times, and in most instances they do. And when we talk about rate increases, we aren't talking about small rate increases. We're talking about 50%, 100% rate increases. And, we have advisors that come to us all the time and say, my client brought this letter to me. It can't be real. They're increasing, for 3 or 4 years running, they're going to increase their rates by 25% a year until it's been 100% rate increase. And yeah, it does happen. There's another part to traditional long-term care insurance plans that some people don't like. I'll admit I'm not on this bus, and that is that if you buy a traditional long-term care plan and you are lucky enough to go through your whole life, you lead a long life, and then you pass away without ever needing care, and you're in a tiny percentage, number one, but number two, there is no residual value to that plan. So whether you cancel the plan or whether you pass away and never need the plan, whatever premium that's gone into it is not coming back out. And some people are bothered by that. I'll be honest with you. That one doesn't bother me so much. If I'm lucky enough to never need care after seeing what care looks like, I'm okay with that. And I also can tell you that I don't look at my automobile insurance and think to myself, I paid for my automobile insurance this year and there were no accidents and no one stole my car. Damn it. No, that's generally not how I think about it. I'm happy to not use the insurance, but again, some people feel that way. So this is a real letter. And if you're thinking I'm giving you an eye test, I didn't mean to. But I wanted you to see, this is a real letter from a company that has one of the largest blocks of long-term care insurance business out there. And what you may or may not be able to see from where you are is that they are announcing a 50% rate increase right here. And then all of these, this is just, take your 50% rate increase and here's how much more you're going to pay. But over here, we'll show you how you can get a lower premium, but also get lower benefits so that you can look at various options as to how much you want your rate to go up or how much you want your benefits to go down. So you may have noticed if you looked carefully, and I did this, it's hard to see, but that's a 10-year-old letter. Since that time, this person's gotten 3 more. You see these rate increases, and I only share this so that you understand the impact of the rate increases is really, really significant and going way, way up every year. Okay, this is an older slide, forgive me, but it does tell us what's gone on in the market. Back in the day, traditional plans were the biggest part of the market and hybrid plans were the smallest. Now, ever since 2014 and today, this would look like almost 100% of the plans sold out there are what we call hybrid plans. So let's talk about what is a hybrid plan. It's a fancy name for a life insurance policy and a long-term care insurance policy that are married together, hybrid, to become one policy. Nobody buys a hybrid plan like this because of the death benefit. I'll explain the role the death benefit plays. This is 100% about buying long-term care. No two ways about it. So the difference, however, and the reason that hybrid plans have basically taken over the market is because hybrid plans guarantee the amount of the premium. If you're not paying for the rest of your life, it guarantees the length that you will pay the premium. It guarantees the long-term care benefits, even if you buy an increasing long-term care benefit, which is, by the way, something we encourage. It guarantees the increases. And if you're lucky enough to never use the long-term care benefits, it will guarantee a death benefit at least equal to, if not greater than, the amount of premium that has been paid in. So while that death benefit is not huge, it does guarantee that whatever money that goes into this plan is coming back out, even if you never use the long-term care benefits. There are numerous payment options with these types of plans. Sometimes people like to just get it, one and done, so that it's paid for and then they're finished with it. So you can pay it one time. You can make 5 payments, 10 payments. You can pay for the rest of your life. It really comes down to what stream of payments is most comfortable for you. And then there are a number of ways to fund these plans. And the funding can come from different things. For example, if you have an existing life insurance policy and maybe no longer need it and it has cash value, some or all of that cash value could be used to help fund the hybrid long-term care plan. What happens for a lot of people in that situation is they bought the life insurance when their children were very young because they were worried about dying too soon. And then you reach a point in your life where your kids are grown and they're all well, and now instead of worrying about dying too soon, you're worried about living too long. And you are kind of transferring from the risk of dying too soon to the risk of living too long. So when we talk about these hybrid plans, I find that there's a very easy way to understand them and understand how they work. And that is using these buckets, the live, die, or quit buckets. When you buy one of these plans, it automatically and immediately fills 3 different buckets for you. The first bucket is your long-term care bucket, or the if you live bucket, because if you live long, you're likely to find yourself in a care situation, and there will be a bucket of money waiting to help you in that care situation. If you are lucky enough to live your whole life and never need the care, then there will be a bucket of money that would be paid to your beneficiaries at the time of your passing. So if you live and you need the benefits, great. If you die and don't need the benefits, great. And there's even a quit option. Different carriers do this different ways. I can't be quite as specific here, but many carriers will offer a percentage of the premium that was paid in, say 70%. Some carriers will offer 100%. Some carriers offer north of 100% of the premium that was put in. But at least some of your money comes back out, even if for some reason you decide to quit. Now, there's something I should share with you about that. The insurance company out there that has the largest block of hybrid long-term care insurance reports back to us that fewer than 2% of the people that have ever bought the plan actually cash it out. So basically, everybody keeps these policies once they own them. So at this point, I usually get 1 or 2 questions about some things. And one of the first questions I get is, I don't want to go into a facility. So if I live and I need these benefits, can I stay at home? The answer is yes. And I notice it wasn't like, well, let me explain. The answer is yes. And in fact, another carrier that has a very large block of long-term care insurance business reports to us that better than 3/4 of the claims made on their policies are made for services that are provided in the home. So you can definitely stay at home. Most people would prefer to stay at home. And most claims do not start with, oh my God, this person went from everything's great to immediately in a facility. Most, and if that happens, it's because of a tragic injury or something like that. Most claims are sort of a fade in. My father, who I've already mentioned, is in memory care and really is in a significantly cognitively impaired situation. He didn't get there overnight. It started, and then he needed a little care, somebody to come in a couple of hours a day, a few days a week to help out and help my mother help him and that sort of thing. And then it grew, and it was more hours a day and more days a week until ultimately he finds himself in a care facility where he needs 24-hour-a-day care. But these things happen over time, so a lot of the care in the beginning starts in the home, and for many it ends in the home. It just depends. The second thing that I usually get asked right about now is, well, I would prefer my kids take care of me. And I'm sure everybody would. And if you have a child that's willing to do that, what have you, the question that you're really asking is, can I use the long-term care money with my child? And there are 2 different types of benefits out there. One is called a reimbursement and one an indemnity. A reimbursement benefit means you have to show receipts to the insurance company to get the money. So if you're spending $2,000 a month for care and you've got a receipt for $2,000, you send that to the insurance company reimburses the $2,000. There are other type of plan is called an indemnity plan. An indemnity plan simply pays the benefit. If your total benefit is $5,000 and you go on claim, they send you a check for $5,000. What you do with that check is up to you. So for example, if you've got a family member that you wish to pay out of the $5,000 a month that you get, you can pay a family member to take care of you. All right. I'd like to take a minute and look at a very real situation as it relates to what does one of these policies look like in reality. So this is a 55-year-old male. This 55-year-old male put $100,000 single premium into this policy. In year one, that means that there's a $241,000 pool of long-term care money, which this person could access if they went in, if they needed care right away. Unusual for a 55-year-old, obviously, but they would be able to get $4,819 per month over 4 years, or the total of $241,000. Now, that benefit is going to increase each year by 3%, and it will happen that way for the rest of their life. Now, if this same person were to pass away in the first year of their policy, the death benefit is $223,000. And if this person said, I really just want to get out of this thing, I made a mistake, the surrender value at that point is $77,000. Again, nobody surrenders these things. But if you're anywhere near the age of 55, and I'm not that many years ahead of 55, okay, I'm pretty many beyond 55, but I'd still like to think of myself like that. And either way, even at my age, I cannot think of myself, really needing long-term care. So I took this 55-year-old and I aged him 25 years. At 80 years old, we can start to think maybe a little bit more about, might I actually need some help? And at that point, due to the 3% inflation growth, our pool of money has grown to $491, or our monthly benefit has now grown to $97.97 per month over a 4-year period of time. And it will keep growing at 3%. I just took this 25-year stop in time when this person is 80 years old. If this person were to pass away at 80, the death benefit is $125,000, and as I mentioned to you, the death benefits on these plans, generally speaking, are always at least equal to, if not greater than, the original deposit, which in this case was $100,000. And if this person decided at age 80, which no one would ever do at age 80, but at age 80 they want to get out of this plan, there's a $70,000 return of premium if they surrender the policy. So whether you live, you die, or you quit, the money that goes into these plans is coming back out. And that's an important thing to know and understand. And the next thing that's important here is all of these numbers that you see on this page are all guaranteed by the insurance company. There is no, well, the interest rate didn't, or the investment account didn't, or the insurance company raised the cost, or this or that. Everything on these plans is guaranteed day one, dollar one. So really, really a comforting thing to know and have in your portfolio. So usually somebody wants to know, well, who's buying this stuff? And I can tell you that the real reason on who buys this is not on my list. Anybody that has seen this in their own family buys it. You don't have to see the numbers and the claims and the impact on the family and impact on family relationships and everything else to really get a sense of this is something I want to do. I personally say it to my children all the time. I will do better than what's going on with Grammy and Grampy, I promise. You see it and you know it. But generally speaking, it's between the ages of 45 and 70. And by the way, the average age goes down every single year. And the reason is because obviously people are seeing family members. and it's less expensive the younger you are, and it just goes down. So when I can think back not that many years ago, the average age was very close to 60. It's now very close to 55, and it is coming down lower and lower every year, and certainly something to think about. Another reason that I believe the average age is coming down is because there are a lot of parents and grandparents who are seeing their own situations and what have you, and they are buying policies for children and grandchildren, so that this is one more thing they don't have to worry about. Second is obviously avoiding dependence. No one wants to put their family and friends in a bad situation. And when I say dependence, it's not just financial dependence. We're talking about, do I want to have my children have to do, perform things to and for me that would be uncomfortable for them and uncomfortable for me? And the answer is no. And it also puts your children into a situation where they are not trying to figure out what to do with your assets. And when there's a pool of long-term care money, it's a lot easier for them to spend that money on your care than it is to start making decisions about which of your assets need to be sold off and how to come up with the money to pay for this. Even if it doesn't cover all of it, if it covers some of it, it takes a lot of the pressure off of kids who are looking at how to care for mom and dad. This also gives you the opportunity to choose care options. This is an unfortunate thing that I want to share with you, but it's a reality. All facilities, 100% of facilities, as well as organizations that provide care in the home, are hiring. 100% of them. There's not enough care to go around. And the facilities, as well as the care providers, are very much more interested in people who have insurance than people who don't. They know they're going to get paid. And so you may find that in some areas, depending upon where you live, that those who are providing care are much more interested in you if you have an insurance policy. And then the last attribute of those who buy it is obviously people who have somewhat of a premium tolerance. This stuff's not inexpensive, but then again, the back end, which is the claim, wow, paying for care is really not inexpensive. And I can tell you some real tales of woe about just my own family. So at the beginning of our presentation today, I told you that I was giving away my biggest point right up front. I also told you I'd repeat it, because if you take nothing else away from our chat today, it is my sincere hope that you will remember you need a plan. And it's not a plan that you're going to put together when things have already gone badly. It's a little bit like saying I'm going to go out and find fire insurance after my house is on fire. No, that's not when that's going to happen. And you're not going to have a plan on how to rescue everybody from the house when the house is on fire. You got to think about that in advance, and it's the same thing here. You want to visit with your financial advisor about how this will happen. You want to visit with your family about how this will happen. And as I said earlier, I'm not trying to scare you with statistical data, but by and large, it's not as much of an if this is going to happen, it's more of a when it's going to happen. So I hope I gave you some good takeaway points, and at this time, I would happily entertain any questions that you may have.
Thank you so much, Michael. That was wonderful. And I know that the gist of the information hasn't changed that much in the last 5 years, but certainly the statistics and the information has. So thank you for giving us this update. It's been very insightful.
My pleasure. Thank you.
If anybody has a question for Michael or for Dan, you can put it in the chat box or the Q&A box. We do have a couple that have come in already. So one person asked, I want to be able to stay at home for as long as possible, even if I need care. Will long-term care insurance cover at-home care?
Good question. And as I think I may have mentioned earlier, it comes up every single time. And the vast majority of claims for long-term care insurance are, in fact, for services provided in the home. And you're not alone, by the way, whoever asked the question. Everybody wants to stay at home if they can. But sometimes it comes down to basic safety elements. Somebody who's cognitively impaired and could wander off or something like that usually cannot be in a home situation. So they end up in a facility situation. But yes, definitely services can be provided at home.
Okay. A follow-up to that. If I want a family member to care for me and I want to compensate them, are there any policies that would cover that type of situation?
Also an excellent question. And the answer is you need to be sure that you get an indemnity policy as opposed to a reimbursement policy. A reimbursement policy will require you to send receipts that from your care that you got to the insurance company, and they'll reimburse it. An indemnity policy says whatever your benefit is, if you go on claim, we pay you the money. And even if you're not using all the money, let's say you've got a $10,000 benefit, but right now you're only using $2,000 worth of care, you simply take the other $8,000 and bankroll it for potential future use to care for you. And that also gives you the opportunity, since you're getting a check for the full amount. If you choose to use it to pay a family member, you certainly can.
Well, that's good news.
Great question, by the way.
That's a pretty common situation, it seems like, from people I talk to. So this is a good one because, I've only personally experienced just like insurance claims when it comes to, say, a car accident, but they're asking, I'm worried if I purchase a policy, the claims experience will become burdensome and the insurance company will be a big hassle. Is owning a long-term care policy worth the trouble?
A great question. I have the same problems all of you do with my medical insurance, and they don't want to pay for whatever, and and I get it. Life insurance is really easy when it comes to claims. You can either fog a mirror or you can't. And if not, they pay the claim. Long-term care is not quite that cut and dried, but it is not far off, because you are either cognitively impaired or you cannot do 2 of the 6 activities of daily living. And I will tell you, based on my experience, that I've seen very, very few, if any. I cannot honestly think of a claim that was denied that I thought was a legit claim. They are usually very, very good about it. As I mentioned, I have 2 parents that have been through this. By the time that they actually did do an interview with both of my parents, and by the time they did the interview, their cognitive situation was at a point where there was no way they weren't going to qualify for the claim, and they did. They both have reimbursement policies. Their policies are very old. That was before you could get an indemnity policy. And the insurance company has a website, and they've made it very easy to upload receipts, and the reimbursement checks come like clockwork.
Oh, that's really good news. Someone just asked, is there an age you would say someone is too old to purchase long-term care?
The oldest issue age that I'm aware of from any insurance company is 80. That said, when you get above 70, the premium amounts become really prohibitive. It's not to say that it's a bad deal at that point. It's just, for a lot of people, it's a big check to write above age 70. So the younger you are, the less expensive it is, much like other insurance. And, I encourage you to start early. There's also one other thing to keep in mind. There is a very high rate of declining coverage for people. And by high, I mean, give or take, a third of the people who apply for coverage will not be offered coverage. And sometimes it's for simple reasons. Quick, without belaboring the point. If I use a cane to move around at all, but I'm in perfect health, otherwise everything's great, for life insurance, I would probably be able to get a very, very favorable, if not best class, life insurance policy. But for long-term care insurance, I'm in instant decline. If you have to use anything to move around, a cane, a walker, a chair, whatever it may be, you are instantly declined for long-term care. So keep in mind that is there a maximum age? No, but the number of people over the age of 70 who can make it through the underwriting is really shrinks.
Okay, that's a great point. Thank you so much.
Of course.
Okay, it looks like we have one more question. So where or how are you seeing people funding the purchase of long-term care policies?
Um, the great question. And the answer is it does get pretty individual. Let me give you a few quick different examples. If any of you are watching the market right now, I presume you are, you know that we are at like record highs. And so there's a lot of people out there whose portfolios, particularly in the past few years, have really hit much, have really benefited from a very, very comfortable market. And so some people are taking wins off the table. It's like, look, my portfolio is up 5% in just a few weeks, months period of time. I may take some of my wins off the table and redeploy that to buy a long-term care insurance policy. For some people, they had money set aside for other things, perhaps children's education or what have you, and the kids didn't spend all of it, and they may be using some of that money. For others, it's an existing policy. I think I mentioned this earlier in our discussion, but that somebody bought a life insurance policy when their children were young. Now the children aren't young anymore. They're not worried about providing a benefit if something should happen to them, but they are worried about now, instead of caring for their children, they're worried about their children having to care for them. And so they redeploy the cash value of a life insurance policy to make the purchase of a long-term care insurance policy.
Okay, so that goes back to what you were saying about the risk of dying versus the risk of living.
Exactly. It just changes at some point in your life. Your kids reach a certain age, you reach a certain age, and all of a sudden, I'm not worried about dying too soon. I'm worried about living too long.
Well, thank you so much, both of you. I really appreciate all of your time today, and we love working with you all. We love just helping our clients understand the benefits of long-term care insurance and when it's needed, why it's needed. So we look forward to seeing you all again soon. And if you all have questions after this, we are going to put this up on our YouTube channel. It will be available for you to share with friends or family that might need it. You might want to share it with your siblings if you have parents that are going through this. You can reach out to us at info@elevate-wealth.com, and we'll make sure any further questions get answered. And in the meantime, we hope you all have a wonderful day. And thank you again, Michael and Dan, for your time today.
Thank you,
Betsy.
Bye, everybody.
Take care. Thank you so much. Bye-bye.